Work together 15.2. We are going to record a couple of adjustments. They are going to be our merchandise inventory and our interest income. All right, so when we look at the instructions on the first one, it says, from a physical count of merchandise inventory on December 31st, balance is determined to be $96,471.25. Journalize the adjusting entry for merchandise inventory. Okay, you can see that this is the balance, the ending balance. Remember, for merchandise inventory during the fiscal period, when we purchase merchandise, we put it in our purchase account. When we sell merchandise, we put it in our sales account. So again, our merchandise inventory, we don't do anything with until we make an adjustment. You can see that right here from our adjusted trial balance. If you click on that tab, right there, you'll see our merchandise inventory at the beginning of the fiscal period was right here. This is the amount at the end of the fiscal period. So now you're going to figure out the difference between those two numbers. If you look at it at the beginning of the inventory versus the end, you can see that the inventory has gone up. So we're going to increase our merchandise inventory by the difference. Remember, merchandise inventory is an asset, so to increase an asset, we have to debit it. But first of all, we need to figure out the difference. We will take the larger of the two numbers, $96,471.25, which is the ending, minus the beginning, $94,845.31. And that was our beginning balance. And you can see that the beginning was lower than the ending, so therefore throughout the fiscal period, the balance has gone up. And the difference is $1,625.94. Okay, so that is the amount right here that we have to make an adjustment for. So let's go down to our journal, and you can see the adjusting entries we've completed so far. Our allowance for uncollectible accounts, we did that one. The last lesson, we did the supply and the insurance expense. Now we're on to adjusting our merchandise inventory. So the date is the 31st. We said that our merchandise inventory went up. It is an asset, so therefore merchandise inventory has to be debited for the amount that we figured out on the top. Okay, merchandise inventory is going up. Remember, merchandise inventory does not have an expense account, so we use the temporary account income summary for the credit part of this entry. So again, once we post our merchandise inventory, our inventory value will be brought up to date. Okay. Our second entry is listed above. A single notes receivable is outstanding on December 31st. The 90-day 8% note was signed on November 22nd. Journalize the adjusting entry for the notes receivable. So first of all, let's figure out how many days are in this year, this fiscal period. Those are the days that we're going to receive the interest on. And then we'll get the rest of the days next fiscal period. So it was written on November 22nd. So November 22nd to the end of the month equals 8 days. And then you had it all of December. And that is 31 days. So the amount of interest that was accrued this fiscal period is for 39 days out of the note. So the other, let's see, what do we got? 51 days will fall in the next fiscal period. Okay, to see how much interest we've accrued, we take a look at this account right here, our notes receivable. It says it was a single account there. So we're going to take the principal of $8,000 times the interest rate of 8% times 39 days out of 360 days. And we will have an interest that has accrued of $69.33. And this is the adjustment we need to make. So we identify the income that we had in this fiscal period. Okay, so let's go down to our journal. The date is the 31st. We're going to start with the interest that's owed to the business is going to be taken out of our interest receivable, or it's going to be in our interest receivable. That is the amount that when the note is actually cashed in or paid for, we are going to put in this fiscal period. The amount of interest, which is interest income, will also go up by $69.33. So at the end of the fiscal period, you can see this value has gone up and this one is increasing. Our merchandise inventory also increased. And remember, with our income summary, we don't have a normal balance.